This is Professor Hazer again, and this is, as it turns out, these are going to be 4 videos, but this one will be a little bit longer. The last will be incredibly short. Anyway, in this video is going to be a continuation of the first video on leverage. And as you recall, in the first video on leverage, we went over 2 things. Number 1, the concepts. The 2 concepts are, the main concepts are, number 1, that it's the asset values that drive a firm and not its mixture of capital, debt versus equity. And the other, and the modified version of this is that people, Modigliani and Miller, the people who made this theory, who argued this, modified the theory to recognize that interest is tax deductible and therefore has a value. Okay, the next part of this theory is that instead of using the constant growth formula, we're going to use a no growth type of perpetuity formula, terminal type formula. And that's a much easier equation. It's your cash flow, which never changes, divided by your no growth cost of capital. And mainly we're going to use it to calibrate the model more than anything else. Okay, so let's get right into this. Okay, so on the valuation sheet here, we had originally, the place where we stopped was we had calculated 2 levels of free cash flow to the firm. First one is free cash, what am I saying? 2 levels of free cash flow. First one is free cash flow to the firm, which is the cash available to pay both interest and dividends. And then we took out the interest net of taxes, which gives you the free cash flow to equity. FCFE is free cash flow to equity, which is the cash flow available to pay dividends. Okay, so let's get right into this. And what we're going to do is we're going to do a couple of extra calculations, but the main thing is that we're going to estimate the value of the firm with debt, assuming that the firm has no growth. Okay, and so let's first of all, I'm going to calculate something called the unlevered cost of equity, or you could say the unlevered cost of capital. So I'll put it there. And I think what I'm going to do is change it. Instead of calling this cost of equity, I'm going to call it the unlevered, no, return on equity. That's fine. Okay, and notice that I put the word unlevered here. Okay, and the reason I'm putting the word unlevered cost of equity is, let's go back to these concepts here. And keep in mind that we're dealing with 2 types of firms. Unlevered firms with no debt, and then levered firms with debt. So what we're doing here is we're calculating the cost of equity, the cost of common stock for a firm with no debt. Now keep in mind that theoretically, from a common sense perspective, if you own equity in an unlevered firm, that equity will be less risky than the equity of a stock which somebody owns in a levered firm. There's 2 reasons for that. One is if you have a lot of debt, it just diminishes the value of your common stock, and sometimes if the firm goes bankrupt, maybe the debt holders get the first proceeds from the bankruptcy, and common stock is worth less. The more common reason is that firms with debt have what is called financial leverage, which I probably would have gone over in the class before this had we had the traditional class. What financial leverage means is that if you have a firm with debt, the riskiness of the stock, and the riskiness in terms of its standard deviation, in terms of the way the stock price bounces around on the stock market, will be much higher than firms without debt. So if you own stock in an unlevered company, the stock may be steady. It's not going to be bouncing around a lot. Not going to have a lot of variance. The returns won't have a lot of variance. Whereas own stock in a firm with debt, the stock will probably be bouncing around a lot. The more debt you have, the riskier your stock is. Okay, so let's go back here, and I'm going to put in the formula, the line items for the formula here, and then I'll just go down and describe this. Okay, so the first item we're going to do is, and we'll abbreviate RF, which stands for the risk-free rate, and I'll just go ahead and write that in, just so you know what that means. RF is the risk-free rate of interest, and that's just the rate of interest on a bank account or a government security. Okay, the next one is, I'm going to call it BU, and this is the beta on an unlevered firm. Okay, and so this is, like I said, a lot of this is finance. Now, beta is a measurement of risk in the market. Every firm that trades on major exchanges has a beta calculated for it. And beta, and this is not a finance class, that's why I didn't go over this, but from undergraduate finance, you should know what beta is. Beta is the relationship of the returns on a stock to the returns on the stock market as a whole. So if you have a beta of 1 and the market goes up by 1%, your stock goes up by 1%. If you have a beta of 1.2 and the stock goes up by 10%, your stock should go up by 12%, which is 1.2 times 10. Okay, but keep in mind that betas, the riskiness, the higher the beta, the more risky is a firm. Okay. However, keep in mind that once again we are distinguishing betas on unlevered firms from betas on levered firms. Okay, so you could, and this is commonly done in finance, is you can calculate actually a beta for unlevered companies, and then take similar companies and estimate the beta, assuming that the degree of debt goes up. Okay, so but right now we're concentrating on the beta for unlevered firms. Okay, the next one is a market premium. And this is the premium that the stock market would charge over the risk-free rate. So if your risk-free rate were, let's say, 5%, and I'll do this in a second. If the risk-free rate were 5%, the market may charge, say, well, risk-free securities are 5%. The market would charge more on risky securities, which are stocks. And then you do this by using the S&P 500, etc. And so basically the market premium is the amount of risk the market charges for a stock in excess of the risk-free rate. Okay, and finally, we'll just put this is going to be the result of the formula. So this is going to be RU, which is the return on unlevered equity. Okay, now let's just go ahead and make some assumptions. Okay, let's assume, and the example goes back to around the year 2000, when the risk-free rate was about 5%. Okay, and I'm just assuming this. This is assumed. Okay, the beta on an unlevered firm. I believe that we did do some research back then, and one of the reasons I'm using an old example is because we had done the research. Okay, the beta on an unlevered firm at that point, like a beta on an unlevered firm like Lilly, and I think we looked into healthcare, was about 0.9. So the beta on an unlevered healthcare firm or unlevered drug maker at the time was less risky than the market. Keep in mind, a beta of 1 gives you the beta of the market. Now, the market risk premium at the time was about 8%, 0.08, and this is assumed too, although back then we did do the research on this. Okay, and 8%, really 8% should be equal to more or less the return on market less risk-free rate. Okay, and I'll go ahead and stretch this out here. And what we're saying with that is that in this example, maybe the return on the market was probably 0.13, which was probably true at the time, minus 0.05, which gives you 0.08, and this is assumed too in a sense. But what I'm saying is that 0.08 right here plus 0.05 gives you this 0.13 here. Okay, so the market as a whole was returning 0.13, and then the market for healthcare providers or whatever, for drug companies, and then risk-free was 0.05, so the difference between the two is your market risk premium. Okay, so now let's look at the results of this formula here, and what I'll do is I'll put the formula in and then go over the formula. I'll write out the formula. Okay, so let's just do this. The formula is your risk-free rate plus the beta on an unlevered firm times the market risk premium. Okay, so the return on unlevered equity is, at the time, was 12.2%. Returns were higher back then. We had a better economy. Things were better, frankly. But anyway, so let me just write this formula in for you so you can, so you'll have an idea of what it is. Okay, let me get this over here. The return, this formula right here is basically you take the risk-free rate and you add to that the product of the beta on an unlevered firm times market premium right here, and we'll just go over here and put MP over here so you know that that's market premium. Okay, now that we have our return on unlevered equity, we're ready to do the purpose of this video here. We're ready to do the valuation of, we're going to do it two ways. We're going to do the valuation of Lilly, assuming it has debt, but that it doesn't grow. We're going to be using, for our valuation here, we're going to be using the no growth formula, terminal formula, which is this formula right here. Very easy formula. Okay, and so basically what we're doing, we're assuming initially anyway, we're not assuming growth, and we're assuming that Lilly goes on forever but doesn't grow. And then what we're going to do at the end in the fourth video is just add a little bit of growth then. Okay, so first what we're going to do is go, I'll outline this here. We're going to do this. This is no growth valuation. And we're going to do this two ways, and so we'll do this like this. First way I'm going to do it is something called the adjusted present value approach. And then in the next video, we're going to do the weighted average cost of capital approach. And there's actually the return to equity approach. There's actually a third way to do it, but I don't really like that way. So a lot of people love that, doing it that way, but that's I don't like doing it that way. Okay, so the first thing we're going to do, and keep in mind the concept here. Once again, I'm going to go back to the concepts. The major concept here, we're going to go back to the philosophy of these valuations. The major concept is that the value of firms is determined by their assets and the assets of those and the management of those assets. The second concept, though, but the concept was modified to recognize that interest is tax deductible. So basically, we're going to stick with this concept that assets determine the value of a firm, but then you make an adjustment for the tax deductibility of interest, the tax shield, kind of like we did in the examples and the capital budgeting, net present value examples in class when we actually had classes. Okay, so let's do this. It's a fairly short calculation. I don't know how long it's going to take, but it's a fairly short calculation. Okay, so let's do this. First, let's, and keep in mind that we are going to use the no growth formula. So rather than using the constant growth formula, we're going to assume that Lily doesn't grow. And in the end, after all is said and done, the final video will add some growth. Okay, so the first thing we're going to do is we're going to compute value of unlevered firm. Okay. And what we're going to do is using the no growth formula, which is sum cash flow divided by the cost of capital. So we're using this formula right here. What we're going to do is the value of an unlevered firm. So what first we're going to do is the cash flow we're going to use here is free cash flow to the firm, which is calculated up above. And then we're going to divide that by the return on unlevered equity. So we're basically, conceptually, we're assuming that Lily looks like this right here. We're assuming that Lily has no debt. And then what we're going to do is we're going to add the value of the tax shield, which according to these authors is the only value of debt. And then we'll get the value of a levered firm. So, but then we'll, okay, so we're going to use this formula here. Okay, so we're going to use the no growth formula. So we're going to take free cash flow to the firm. Now, free cash flow to the firm is that number right there. And percentage, I don't know how it came to be percentage there. Okay, we'll reformat the cell. Currency, we'll do 2 spaces. So your free cash flow to the firm is 1633 1633.82, and then we're going to divide that using the no growth formula by your return on unlevered equity. Okay, and it keeps giving me these percentages. I don't like that. I'll just use a number here. That looks good. 4.2%. Okay, so I'll go out here. I'll go ahead and I can do it. Yeah, it's fine. Or put it right here. I'll make sure I have no intermediate columns. We'll just put it right here. So the value of an unlevered firm, and we'll put it right here, is equal to free cash flow to the firm, which is the cash flows produced by all the firm's assets, divided by 12.2%, which is right there. Okay, so the value of an unlevered firm, looking like Billy, is $13.392 probably billion right there. Okay, and that is the value of an unlevered firm. So right now we're assuming that Lily looks like this. That Lily has no debt. Okay, now going back to the theory is, from the concept, is that what we're going to do now is add debt, and we're going to say that the only value of that debt is the excess cash that is produced by the tax shield. Okay, so I'm going to go ahead and put in a formula which may not be quite logical and explain that. Okay, so the way you get the value of the tax shield, so I'm going to do this. We're going to go over here and we're going to put value of tax shield here. Value of tax shield. And just make it that. And the value of the tax shield, the value of this cash flow, keep in mind that it's cash flow, all we're going to do is take Lily's level of debt and we're going to multiply that times the tax rate. That'll be TR. The tax rate will be TR. Okay, and that may seem kind of strange that you would get the value of the firm by taking a value of debt by taking the value of the debt times the tax yield, but I'll explain that in 2 minutes. Okay, so I'm just going to go here for a second to make sure that we're using the same cash flows here. Okay, so the value of debt here is going to be, I'm going to go up to the balance sheet here, okay, and we'll get the value of debt. Okay, long-term debt, mostly long-term debt, but let's go up and get the value of long-term debt. And the value of the debt we're going to use is that right there, plus that, I'm assuming, because there's long-term debt on the balance sheet. There's long-term debt on the balance sheet plus other non-current liabilities. Okay, and that gives you, we're saying that the Lilly has basically long-term debt plus other long-term liabilities. Other long-term liabilities could be things like leases and stuff, which would reflect the riskiness of Lilly debt. Okay, and then we're going to take the, we're just going to multiply it times the tax rate, and the tax rate is all the way up here. Tax rate is going to be all the way up here. I think it's 0.22. So there's your tax rate, 0.22. It's in the ratios way up. You just go almost to the first row. And then if we multiply the value of the debt times the tax shield, what we get is the value of our debt is about $1.2 billion. Well, assuming these aren't billions. Okay, and now I want to go back theoretically. It may seem a little strange that we're getting the value of our debt by taking the debt times the tax rate, but let me put a little more detail, explanatory detail into that right there. The value of the debt should really be the cash flow, the tax cash flow it produces, divided by some return on debt. Okay, and so let's do the formula. Let's do a formula, and I'll prove that you can calculate the value of tax shield by taking the debt times the tax rate. Okay, so the value of debt should really be the cash flow produced by the tax shield by deducting your interest on the tax return divided by some rate of return. Okay, so let's say that in the numerator here, you take the value. This is just conceptual. I'm not going to use numbers. You take the value of your debt and multiply that times your interest rate. We'll say return on debt. Return on debt, that's your interest rate. And you multiply that times your tax rate. Now think of what this gives you. Take your debt times your interest rate times your tax rate. That's going to give you the amount of debt that you can deduct, the cash flow that's produced by the tax shield. Now, if you divide all this by the return on your debt, what happens is the return on the debt is both in the numerator and the denominator, and those two things cancel out. I don't know how to exactly do this, but the return on debt is both, in this formula, is both numerator and denominator. So those cancel out, and you're just left with debt times tax rate, which is what I have here, debt times tax rate. So given that your return on debt cancels out in that formula, you can, in fact, just take the debt and multiply times the tax rate to get the value of your tax shield. Okay, so what we have here is if you add together the value of the unlevered firm plus the value of your tax shield, that's going to give you the value of the assets of an unlevered in a sense, the value of the firm, in a sense. So all we're going to do is, and we'll put a little line here, say that's a subtotal, to mark that as a subtotal. But what we're going to do is we're going to add the value of the unlevered firm plus the value of the tax shield. And that's going to say that assuming Lilly were an unlevered firm, that gives you the value of a levered firm. Okay, so we're saying that given the level of Lilly's debt, 22% tax rate, and basically using this formula here, but recognizing that the return on debt, the interest rate, the RD, cancels out. RD is return on debt and interest rate. Okay, assuming that, we're taking the value of an unlevered firm, adding to that the only value that Mediglia, Annie, and Miller said that debt is worth, which is the value of the tax shield. We get the value of the assets of a levered firm. So conceptually, we're doing what Mediglia, Annie, and Miller said. They said initially, there's no difference between the value of an unlevered firm and an unlevered firm because it's determined by the assets. But then we're adding to that, given that they did revise their theory, the value of the tax deductibility of interest, and then so we're getting the value of a levered firm that has Lilly's risk and their credit risk, total firm risk and credit risk. Okay, there is one thing left to do here. Now, keep in mind this is the value of the assets of a levered firm. Now, if we take out the debt, we're going to take out the debt here. We're going to take out Lily's debt value. Okay, so I'll just put value of debt. And keep in mind that I'm using book values here. In real life, you would do this using market values, but I'm keeping this simple. Value of debt. And that value of debt, we should already have the number for that, and we do. Move this up here a little bit. The value of debt is just that number right there. And like I said, in real life, you would use the market value. Okay, so, but we'll subtract this out. We'll subtract this number out right here to the value of debt. So if you take the value of the assets of levered firm and take out the value of debt, you're going to get, in a sense, you're going to get the value of the assets or value of equity of the levered firm. And I'm going to put value. I'm going to put value. I'm going to put this in quotation marks. Value of equity of levered firm. And the reason I'm putting this in quotations is because I'm going to make a final adjustment. Not a minor one, but I'm going to make a final adjustment when I get down to the bottom, a couple of rows, to get the final value of equity. I'm going to make an adjustment for working capital. We'll do that in a second. Okay, so anyway, so in a sense, the value of the equity of this firm is you take 14,629, which is the value of assets of a levered firm. You take out the value of debt, and you get the value of a levered firm, of the equity of a levered firm. Now, just to finish this thing off right here, we valued all of the assets in a sense. We took all their assets. One of the things but these are really operating assets because we're assuming that free cash flow to the firm, that this number here, this is the cash flow that's produced by firms' operating assets, by the machinery, their research and development, all that sort of things. But so what I'm going to do, and this is the first time I've done this in class, I'm going to assume that free cash flow to the firm is produced by the firm's operating assets, their manufacturing plant, in a sense, their laboratories, and the research you do in those laboratories. So it's the cash flow produced over the long run by this firm. What I'm going to do, and we kind of saw this in one of the capital budgeting examples that we did in class, it seems like an eternity ago, is what I'm going to do is I'm going to add back to that, I'm going to call it non-operating working capital. And what I'm doing this for is to recognize that, okay, a firm has operating assets, plant and equipment, and laboratories, and basically that's the value you get. That's the value of the operating assets of a levered firm. But that wouldn't include cash in the bank and marketable securities. So I'm going to go ahead and I'm actually going to go back up to the balance sheet, and I'm going to add back whatever cash they have in the bank and their marketable securities, and that'll give me a greater idea of the value of not just of operating assets, okay, and it'll give me the value of all the assets. Okay, so I'm going to put here, I'm going to say this is value of operating assets. In theory, this is all theory, of course. Okay, so if I take the value of operating assets of a levered firm, subtract out the debt, that gives me the value of the operating assets of the value of the equity of a levered firm. And I'm just going to go ahead and add back any cash that they have on their balance sheet and marketable securities, and then we'll figure out the final value of these shares. Okay, so I'm going to go ahead, what am I doing here? I'm just going to go ahead and say this firm had cash of 1945. The firm had marketable securities of, you just saw it. The firm had marketable securities. The asset section here. The firm had marketable securities. The short-term investments they have here. Okay, so that, okay, and so if I add these two things together, this is going to just give me the value of, let's say, non-operating working capital, non-operating assets. And keep in mind what these are. These are cash, and these are marketable securities, the type that you see on a statement of cash flow. The firm is just buying and selling. It's just cash management, basically. Okay, so if you take the value of those two, we're going to get the, I'll call, say, we'll put a subtotal here. We'll put a subtotal. And the subtotal is going to be, we're going to label it, I'll call it final value of equity. No, that's correct. Final value of equity. Levered firm. I'm going to put it in quotation marks because it is the final calculation that we're going to do here, at least for a couple minutes. So this is going to be, in a sense, our bottom line number. So if you take the value of equity of a levered firm without considering the non-operating working capital, and add the non-operating working capital, like the excess cash and all those things, and marketable securities that really aren't producing cash. They're just sort of fluff or capital that's available, or cash that's available for maybe paying dividends or whatever. The firm value here, the firm value including both the value of the operating assets, and I may want to put here operating assets, and less the value of the debt, that gives you the value of the equity of the levered firm. Add back cash and things that are really not operating, that gives you the value of equity of a levered firm. And then what I'm going to do here is just, I'm going to take the number of shares in this firm and number of shares, and when you do this, you can just assume this. You can go over and verify this on the income statement too, but I'm just going to go ahead and put a number. I remember that the number of shares was equal to, you can just link it to the income statement, but I'll just do this. The number of shares was about I had 1078. These are like thousands, millions, whatever. You can just copy this. example, is that number of shares right there. This is not dollars. This is number of shares. So we will reformat that to be a number. And those are thousands, millions, shares, whatever. Okay, so I'll label these shares. Okay, so if I take the value of equity of the levered firm and divided by the number of shares, my no growth valuation should be relatively low, and I get a no growth valuation, and I'm sure that there's decimal points here. I get a no growth valuation of about $11.67 per share. Okay, so that's per share, which would seem kind of low, and it should be, because we're using all throughout this, we have used the no growth formula. So we use the no growth formula here. This also, by the way, the value tax yield is also the no growth formula right there. And so value of shares, value of value, and I'm just going to put here assuming no growth. So value assuming no growth is $11.66 per share. Okay, and that's kind of our bottom line number. What I'm going to do is I'm going to go ahead and do a quick sort of balance sheet, and this balance sheet is going to be the starting point for the next video. Okay, so keep in mind what we did here. We did a no growth valuation, got a final value for the firm of $11.66 per share here. Pretty much using one approach, the adjusted present value approach. Now, in the next video, we're going to use another approach, called weighted average cost of capital approach, and we should get the same valuation. And the reason I like doing it a couple of ways, there's actually 3 ways, but I like doing it these 2 ways, is because I like to make sure that my parameters are correct. If I were doing this using market values, I could kind of use both methods. I should get the same result using both methods, but kind of like model calibration in a sense. You know, obviously the firm is growing, but if we take a no growth, and then in the end we'll add some growth to it, that should give us a reasonable value for the firm. So anyway, so for right now we're getting $11.66. Okay, and I'm going to finish this off making something called a market value balance sheet. Okay, and so what we're going to have here, and I may skip this until the next video here. Actually, it may be instructive to do it on the next video. Obviously, I'm looking here at my numbers. 275. Okay, we can do this. We'll go ahead and do this. Obviously, I have something of a solution. Okay, so I'm going to go ahead and at least try to make the market value balance sheet here, and then we'll continue the next video. If I don't quite get it right here, we'll make it right starting the next video. Okay, so I'm going to start by, this is just a balance sheet using market values, and I should put market values in quotation marks because I'm actually using book values. In real life, you would use market values for like debt, things like that. But there is some aspects to that here. So non-operating working capital, and we have that number right above. Okay, and we're going to take the next item is the working capital plus the value of the long-term assets. The next value. So I'm just gonna go ahead and put WC here. WC for non-operating working capital, and down here I'm going to put that's what it is. Working capital plus the value of the long-term assets plus LTA plus the value of the long-term assets. So it's going to give me the value of all the assets, that one right there. And I'll just put in long-term debt and then equity. Okay, and the numbers I get here are going to be working into the next approach, which is the weighted average cost of capital approach, but I'm just going to go ahead and set it up now. Okay, so our non-operating working capital is that number right there. The working capital plus the value of the firm is going to be equal to, excuse me, equal to the working capital plus the value of the firm there. Not sure that looks right. It's basically, actually, it's basically right. In a sense, it's basically right, but you don't need to add two numbers together. So that should be equal to that number right there. The value of the long-term debt, and really this is a book value, nothing else. Okay, and then the value of equity. So this is a balance sheet. You've got, in a sense, some assets in these two, long-term debt and equity. And I may fix this in the next one. So let's just take one asset plus another asset minus our long-term debt minus the long-term debt gives you the value of equity. And the only thing left to do is I'm going to calculate two variables. One is percent of debt, I would put percent of equity, and these are going to be very important to the weighted average cost of capital example. I may make some adjustments on these, okay? But the percentage of debt is going to be, so we're saying that in a sense, we're saying that our total assets are equal to that. There may be an adjustment I have to make, by the way, but we'll compute the basic numbers here and continue on the next video. So if we take our long-term debt divided by total assets, that means that our debt is about 39% of assets, and if we take for the equity, if we take 1 minus the percentage of debt, 1 minus the percentage of debt, that's going to give us more or less the percentage of equity. So we're saying that our firm is basically financed with 39% debt, 40% equity, and we're going back to this original concept right here that we're going from a non-levered firm to one in which some, in this case 60% is funded by debt and 40% is funded by equity. I'll retake a look at this calculation in the next part of the video. But the next part of the video, or the next video, is we've already used the adjusted present value approach to come up with a no growth valuation. Okay, and the next one is going to be, we're going to use B, which is the weighted average cost of capital approach, and that's WACC. Now, what I'm doing here is not, you can see there's little inconsistencies. I'll try to fix one or two when we start the next video. But this should give you the concept anyway. But you'll see me fix there may be a little bit of inconsistency either in my terminology here or in the numbers I added, but it should be very easily fixed. Anyway, so in the next video, we'll compute the same value, $11.67, but using a different approach. But we should get the same. We should get the same value. But I like to use the two methods to see that I'm calibrating my model. In real life, if you're using market values, you kind of look at the different approaches and see where you can make the adjustments. Anyway, so the next video should be very, and I have to say it's very, very short. And the final video, when we add some growth, should be very short too. Anyway, so everybody take care. Thank you very much.